Today, folks, I'm going to show you the data about inflation. Nobody's talking about why we've seen the end of inflation, what this means for the stock market, because I bought some more S&P 500 index today, but we're going to take a look at individual stock valuations to see what their PE, historical PE ratios looked like versus today, just to kind of give you a framework on exactly how you should feel about this environment and the news you're being fed. If that's a conversation you can appreciate, hit the like button because we're going to look at the Canadian markets, the US markets, and we'll kick it off with the US CPI data, which is the chart most of us are used to seeing, where we've saw this 8.5% in August, but these numbers don't really reflect what is happening month over month because they are brought together in a 12-month trailing period. And the only way we can know that and see the actual data is by coming into the news releases of the Bureau of Labor Statistics and scrolling down where they actually show us the month over month change. And when you take a look at this, something very intriguing happened in July where we saw inflation month over month go completely to zero. For August, it was 0.1, and something tells me for September, it's not going to be that much higher anyways. And the only way we're going to start seeing this really reflect onto the trailing 12 month is as these months progress in these extremely low inflationary environments, that's when we're going to start seeing the data roll off. So come January, February, March, April, we're going to see this fall off a freaking cliff. But that leads to some other concerns, which is what we call negative inflation. Now, I mentioned that, a few months ago, we were in the eye of the storm. That was coming around summer. The beginning of the hurricane was obviously inflation getting rampant out of control. Now we're seeing inflation get cooled right off, but now we have to get through the negative inflation until we head back to a nominal environment. Now, what is negative inflation? Well, as commodities and all these companies were stacking their products up, worried about the logistics problems, they now have to move those products in a constrained spending environment. People are just spending less money out of fear, higher interest rates, mortgage payments perhaps going up. So they're not going to be buying as many of those products, but having the oversupply and them wanting to get rid of those products means they're going to start lowering prices. And again, with commodities rolling over like energy for August, we saw a negative 10 points here, guys, just for like the energy and commodities market here. Now, if this is something that continues month over month, inevitably what we could potentially see is a negative inflationary environment. And that gets very scary for its own reasons when it comes to hiring, the fear of companies. You're going to start seeing that hit the margins and then the profit and the revenues on companies. So that's a whole different thing in and of itself. That does not mean, though, that you shouldn't be buying stocks. But let's look at the Canadian markets real quick here, because I think this is where we're going to experience negative inflation first. Because again, when you take a look at the August data, guys, we're doing a little better than the US with about 7% on all items. Basically, again, if you take a look, at least it shows you the 12-month from August of 2021 to August of 2022. But when we take a look at the month over month, guys, we're starting to see a lot of negative numbers. Transportation's down 2.5. You're taking a look at recreational and education and reading this down 1.3. Like, you're just starting to see a lot of negative numbers. In Canada, we're down 6.5 on energy. If this is something that continues moving forward, I'm going to tell you, you're going to start seeing inflation roll off really dramatically, and we're not going to be probably getting the same pressure on the stock market from the current inflationary environment with the interest rates going up, because it always seems to be the same news, right? The Fed comes out, they raise interest rates, people freak out, they move into bonds and guaranteed investment certificates and government debt because you're getting a 4 to 5% interest rate. That drives up the value of the US dollar. That gets more money out of the stock market, because why get a 4% yield on your favorite stock like a bank stock when you can just put it in a GIC and have absolutely zero risk, or a bond? And that's why we're seeing like the S&P 500 roll over pretty dramatically here. Again, a lot of people are predicting that the stock market still has the potential to fall another 20% or so. I mean, that's the big predictions coming out of like Michael Burry, tons of people talking about that. But unless a negative inflation gets really bad, and I have a hard time believing it will, because the jobs market is so strong still, I'm really intrigued as we head into tech earnings. I think that'll be a defining factor to how much constraint on spending is really picking up toward the end of this inflationary environment. And if we do see that constraint really impacting the big tech companies, then I could potentially see more downside in the market. But considering how good earnings were last quarter, this is going to be an earnings period to very much pay attention to. But on the even on the S&P TSX, guys, we're down 14.52% for the year, and right now for the S&P 500, 25.12%. But again, just take a look at commodities, guys. This is where we know inflation has peaked. I've mentioned this time and time again. You scroll through almost any commodity, whatever you want to look at. Lumber, lithium is the only thing skyrocketing from my current understanding, but everything is basically rolled over. Steel, it's all crashed, right? So inevitably, this is going to pick back up into cheaper products on the market. But let's take a look at some individual stocks. I am kind of blown away by how much we've stepped in time when it comes to your favorite tech companies. Like, I mean, take a look at Facebook. It's now trading to levels it hasn't seen since basically 2017. And if we scroll down from the PE history levels, I love this chart because it's not the best representation of value, because I tend to look at revenue growth as part of value. But as we head into this slowing revenue growth environment, Facebook's cutting costs. They have been spending a lot with expenditures, so we've seen their earnings fall off a bit. And those earnings falling off have really hindered the stock price, because again, we were expecting these, I think Facebook was growing at 18 to 20 something percent, and now it's kind of slowing down to a more nominal rate. But when we take a look at the PE history, guys, right now Facebook's trading at a PE of 11. Historically, in its entire history, it has never traded anything near close to those levels. And it's only been recently, I mean, as of 2021, it was trading at a PE of 24, and those values have dropped in over half. Let's talk about things like Adobe here, another incredible company, guys, which again, earnings have been slowing down their EPS levels. The stock price, because the narrowing of growth that we're seeing in the lack of spending in the market, has changed the projections on how people see the company, but that has also changed the value pretty dramatically. And I'm showing you this because I believe at some point in the future we're going to see growth rates pick back up again. We're living in an unusual time where spending is becoming more constrained. Inevitably that will lighten up, which makes me think that you're starting to see pretty extreme discounts and really healthy buying opportunities in the market if you're looking for a 3-5 year time horizon. Because again, Adobe, guys, trading at a PE of 28. The last time it saw 28, to put that in perspective, guys, was back in around 2013, 2014 time period. Taking a look at PayPal, for example, here. Now, PayPal's a harder one to wrap your head around. A lot of companies like PayPal, Shopify, they have been expanding their expenditures. And again, in a slowing growth environment, that doesn't look good from an EPS standpoint, but don't take this as a one-for-one, that this is the true underlying value of the company. But again, even with PayPal, the current PE sits around, 48? The last time it saw 48 reasonably, you'd have to go back to 2018 time period. Nvidia, this is another big one too, right? Take a look at Nvidia. This one's been such on a crazy growth rate that even at the current value, it hasn't dropped to its 2020 levels yet. And we're starting to see the same with a lot of these really high-end valued growth companies, because Google, for example, its stock is rolling over, but it's trading at PE levels that it saw roughly in 2020. But historically, these are excessively low PE levels for a company like Google. Apple is still waiting. It hasn't rolled over as much. We're only seeing PE levels that we saw in 2020. Microsoft, this is another one where the PE levels are a little bit more than the usual historical levels, but again, we're still only trading at PE levels that were back in 2018, 2019 timeframe. Tesla hasn't had enough EPS levels to give us a real framework, but their PE level has gone from a 2020 at over 1,000 when we were laughing at the value of the stock, to today where it's at 80, which is a pretty good thing to see, considering the EPS growth rate continues to be at a dominant level in this current environment. And just taking a look at the sticks here, guys, we're just going to be coming out of the eye of the storm here, guys, into the second half of this inflation and this recessionary environment story. But again, it's a tale of two stories, with the jobs market being excessively strong, which should cushion a lot of people through this environment, just because it's just such a mixed bag, right? We don't really know exactly what the full impact is going to be, but on the second half, I would expect to see some in negative inflation rates. That's going to be impacting some companies earnings growth, and depending on how long that lasts and just what the Fed does before they become accommodative, because again, inevitably they're going to stop raising interest rates, and as soon as they peak, eventually, if jobs get hit too hard, they'll start lowering the rates again. Now, I don't know how long that takes. It could be another 6-12 months, but I'm promising you, coming into January, the news isn't going to be this raging inflationary cycle anymore. We're going to start talking about, okay, now inflation's getting under control, and it'll be more of an earnings story. So pay close attention to some of these big tech earnings, bank earnings, and just see what the environment looks like as we head into the second half of what I think is going to be your last real opportunity. I think the next 3, 6, 12 months is your last opportunity to start taking on real discounts in the market. And then eventually, when things normalize, spending comes back to a normal rate, and things just become more comfortable for the market, we're going to start seeing growth rates probably come a little higher than we're currently seeing in this environment, which again will lead to further speculation on growth prospects, which leads to higher values and more people buying stocks. But that's just my personal prediction. I'd love to know what you think about all this in that comment section below. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.